Hello and welcome to Vox Markets. I am John Human and I'm joined today by Jamie Constable of Singer Capital Markets. How are you doing, Jamie?
All good, thank you, John. Yeah, good to see you
Excellent.
again.
Yeah, you too. And this is our monthly macroeconomic
Mhm.
overview. And what a month it's been. What a year it's been. What a week it's been.
I mean, yeah, I think if we start trying to talk about the year, we'll be there till flipping next year, I think, basically.
I
But yeah,
think
this
so.
week has been one hell of a week. I mean, interest rate rise after interest rate rise after interest rate rise, hasn't it?
Yeah, so we had today the BOE and ECB both
Yeah,
raised rates by 0.5%, and earlier in the week the Fed raised rates by
yeah,
0.5%. Indicated, I understand that the terminal rate is going to be higher. ECB not
yeah.
exactly putting any punches, pretty
The
hawkish.
ECB today, it's very topical, obviously, out today. I mean, Lagarde basically came out and said we're going to keep raising at 0.5%, and keep on going. And they've raised their inflation CPI forecast as well. So you're talking about 6.5 in 2023 now, I think. So yeah, I mean, she wins the Hawk of the Week award, that's for sure. Blemmernack. I mean, it's interesting there because they are so far behind the curve. Of course, the ECB, they make the UK a bit less, but they're 2.5 at the moment and 6.5 next year. The rates could go up quite a lot in Europe if they really stick to what they're saying.
Yeah, no, I mean that has the potential to do quite a lot of damage. So I guess one of the big stories of the year has been, will the Fed in particular be forced to pause its tightening for fear of stoking an enormous recession?
Yeah.
Have policymakers given up on this sort of trade off?
Mm. I think the US is really interesting, actually, and I kind of differ. But the market is almost challenging the Fed now, which is a very dangerous thing to do, as we know from
Mm.
history. And we saw that last night with the Fed rate rise of 0.5%. And then they moved their dot plot up to 5.1. That's only one more rise, to be perfectly, or maybe 2 quarters or something like that. 2/4% rises to finish. So you're there or thereabouts. I mean, they did. Let's be honest. They did say that inflation has peaked, and we've had 2 months now of inflation coming in below expectations. I mean, I picked it back in the last month, which was the October number in November, wasn't it? That came up
Mm.
back then. Now we had the November number below expectations as well. It's really interesting if you look at goods inflation versus services inflation now, because goods inflation has basically done the peak and come back. So if you look at oil, cotton, wheat, I mean, oil's flat year to date, cotton's well down, wheat's well down, copper's well down. Dr. Copper, as they like to call it, obviously, copper well down, telling you there's probably going to be a recession. So they're all well down. So the question now on Fed and rates is services inflation going to do the same, peak and fall back rapidly as goods inflation has done? Now, that comes down, and Powell was talking about this last night, that comes down to wages in terms of his view. Now, wages is really, we've got this enigma in the jobs market, and I think people have maybe forgotten something here. And being a bit of an old git here, I mean, think back to 2000, everyone was going on about the one thing we really need to look forward to is when all the baby boomers start retiring around 2020. Well, that's where we are now. We're right in the heart of that period now. The baby boomers are retiring. It's been accelerated by the pandemic because they stopped work anyway. There's a little bit of them coming back, obviously, because inflation and cost of living and stuff like that. But if you look at the Western world now, it's not just the UK where you've got loads of job vacancies. Don't travel through hot Netherlands at the moment because they haven't got enough people to staff the airport. Cheaper. So
Mm.
US, they've got massive job vacancies. So we've got a Western world now where we've got the baby boomers retiring. Remember, there's been a lot of wealth creation for the baby boomers, particularly from property markets. So they're generally, quite wealthy as well. So they're retiring, and you haven't got enough people to do the jobs. So I wonder whether they're targeting the wrong thing here in terms of jobs and the labour market, when actually there's not a lot they can do about it. I do think that we will see labour taking a bigger share of corporate profits going forward. In the period of free money, we had this period where corporate share of the profits were at highest ever levels. I think what we will see now is that because of what I've just talked about in terms of labour forces shrinking in the Western world, and I'll come on to China on that in a minute, I think that we will see that proportion taken by labour, take of profits go up. and we're going to have that adjustment. But you can have productivity improvements to improve that. And also, I do think that if we see some of these zombie companies that have been run for cash, as it were, falling over, the return on capital can rise for companies as well. And that can help offset to a degree that pressure that comes from higher wages.
But in the short term, you would think that the incredible number of vacancies that are out there, and the fact that jobs can't be filled, roles can't be filled, will be inflationary. But companies are simply going to have to pay more.
Yeah. It will be to the extent that they keep recruiting. I mean, if demand goes down, then they do rein back a bit. But yeah, it has to be, and we've seen that. Let's be blunt, we've seen it. We've seen it in wage inflation picking up. I mean, in the UK now, private sector wage inflation is 6-7. Public sector, of course, is all the way down at around 2, which is why we've got all the strikes.
For now.
For now, yeah. But that's going to have to go up. Let's be honest. It's going to have to go up. We're going to have this adjustment and a bit of catch up. But I mean, that will wash through. Remember, and what a lot of companies are doing at the moment, they're giving, say, a 4% wage pay rise, but then they're paying £1,000, £2,000 bonus, which then that won't repeat next year. They hope anyway. So you're seeing that. But I mean, that goods inflation falling back is quite important. And I think if there's quite a lot of people saying it could be like the 70s where inflation just went like this. Remember, in the 70s, we started with inflation high and then it went higher. This time we started with inflation at 0 effectively, and it spiked up. Goods inflation has already come back, and the billion-dollar question now is, does services do the same? And that's the big question, I think, really. And time will tell on that. But we've had what we have this year, 425 basis points of rate rises in the States and you think about the magnitude, it's the percentage rise on that. We've come from nothing to 4.5, and you normally say there's a lag for those interest rate rises to take effect. Now it's less in the UK. We've gone to 3.5, so we're a bit behind the curve, and in Europe it's even less. They're at 2.5, so they're even further behind the curve. And on inflation, you have got this big differential, which is really important actually, between what's happening in the US and what's happening in Europe. Because in the US, they haven't got the energy price problem. The gas price in Europe, in the US, is down 2% year on year. In Europe, obviously, it's way up still. So we've still got this energy price issue in Europe, which means inflation will be a lot more sticky in Europe than it will be in the US.
Yeah. What about the dollar? What's the role of the dollar in this? Because I think the last time we spoke, the dollar was incredibly strong. Which for the rest of us is not great, and sort of adds to the inflation problem that we have. What's happening now with the dollar?
Well, it's rolling over, isn't it? It's rolled over quite a lot. We had that day, it was October the 12th, I think, where you had this really big move in the dollar, and you had a 1-to-1 correlation in percentage-wise in the FTSE 250. FTSE 250 went screaming up as the dollar came off. And we've had other days like that over the last month or so. Well, what the ECB said today is another kind of is more pressure on that. Really, the euro's up over 1% today. Interest rate differentials will move currencies. So now, if we're thinking that the US is there or thereabouts, personally, I think the US now, the worry is that they go too far from where they are now. In Europe, there's a lot more to go for. In the UK, there's more to go for, but probably not as much as in Europe, because I think the economy is weaker in general. And we have raised further already. But that means flows move markets, and money's already started to flow out of dollar. And this is positive for European and UK asset values as well, and for equity markets, because if the money starts coming back across the Atlantic, all of this year has been going west at speed, and we've seen that with the European and UK equity markets. But if it starts coming back the other way, that money's got to find a place somewhere, and it will move into assets like equities, and that should be seen as a positive. Maybe what the ECB's done today makes it a bit more positive for the UK as well, because if ECB are going to raise at the rate they're talking about, Europe's going to have quite a hefty recession, I would feel, if they really believe what they're saying.
Let's talk about recession. It does seem pretty nailed on in Europe, as you say, and the UK. The economy here looks very, very weak. Maybe not so odds on in the US, but certainly there's some signs there that the economy is struggling. I think we had some retail sales news there, and it's not looking great. Do we face a global recession?
I think if you look at the PMIs, they signal 6 months ahead. The PMIs, Purchasing Managers' Indexes, are all well below 50. The global ones well below 50 as well. So I think that's telling you, I think we already are in recession. I mean, that's what the ECB said today. We're in recession. The UK is in recession. The US, I think, probably first half of next year. Remember, the first half of this year, they were in recession on the numbers they put out in the US. So we shouldn't forget that. Then,
although they did change the definitions.
They did change the yeah, always a good thing. But let's go back to the old definitions. They were in recession. So then they had a strong Q3. I think first half of next year, you could see quite a slowdown in the US. The middle 2 quarters, you could see a recession. But I think as long as the jobs market stays as we see it, and you still have all those vacancies, I think it will be quite shallow. Europe could be a bit different. I mean, it all depends what they do. I mean, Europe's got some particular problems in terms of Germany with, if you think about Germany, the industrial powerhouse of Europe, where do they sell all their goods to? Russia, China. You're not going to get much help from that at the moment. Similarly for Italy. So I think you get a shallow recession as long as the jobs numbers don't roll over and companies don't start taking people out. So I think that we are in recession. Let's get away from it. But that we shouldn't all get despair about that, because let's be honest, that's what the UK equity market in mid and small caps has already discounted. Look at some of the valuations on some of these stocks. And the old adage has always been markets look forward 18 months. Now, I don't think it's quite 18 months anymore nowadays. It used to be 18 months. Sometimes you think it's 18 minutes at the moment. But that the markets should be looking forward now to the end of the recession. So what we've got to go through now in terms of company earnings is the adjustment in earnings to reflect the economic outlook. Now, to some extent, that's already happening. If you look at some of the house builders, when they reported, they've had profit warnings or downgrades, and the share prices have moved 1 or 2% down, and the next day bounce back up again. So what is already in share prices is very important, I think, really now when we're looking at investment in the equity market. And as I say, markets look forward. So hopefully markets already, they're already discounting to a degree a recession because we've had interest rates rising. And then they will start to look for the recovery, which is why everyone talks about the pivot in the US and are we pivoting now, and why Powell was so at length last night talking about we're not going to move the 2% target up on inflation. We're not going to pivot until we see inflation down. And the reason he's doing that is because he's scared to death that all the work they're doing will be defeated by market euphoria. And he wants to make sure that inflation is defeated before he admits that.
You can understand why he would be concerned about that. I mean, every time there has been the slightest hint that the Fed may take its foot off the gas, markets have been off to the races. Yeah,
no, totally, and because of the nature of the US economy and investment and confidence and how much services is same as the UK, to be fair, a part of how much that drives the economy, consumer spending and everything. Yes, I agree. He wants to make sure that the fall in inflation is pretty deep rooted before he gives any hint that they finished raising. But he's not going to say he's done it until he's not going to say it until he says it, if you get what I mean. He can't say it until he's there. So if we still keep seeing inflation coming in below expectations, and it keeps falling back relatively rapidly, then the case for him to make further interest rate rises falls every time. So if you're never going to pick the bottom in the market, and let's be honest, are we within 10% of the bottom, or have we seen the bottom? The US is a bit more complicated because valuations are higher, but they always tend to be. But we're there or thereabouts on US interest rates, I think. Now, inflation could be sticky on the way down. It'll be a lot less sticky in the US than it will be in UK and Europe, unless, of course, we get some kind of resolution to what's going on in Ukraine. But I think the US, you could see inflation fall back quite rapidly.
Yeah, and presumably then that would support markets, and that you would expect there to be some kind of knock-on effects around the world.
Yes,
where
totally.
that's been the case.
Yeah, totally. That's what I'd expect to see, because obviously the US leads the world, and from that point of view, and then investors will start to look towards who's going to be the beneficiaries of us coming out of recession, what sectors, what company, from that point of view.
Yeah. Should we talk about China? You mentioned China very briefly there. Obviously, it's been one of the biggest stories of the last year. You know, it's whereas the rest of the world has opened up, obviously they've persisted with zero COVID policy and
Yeah.
lockdowns. That policy looks like it's coming to an end. What's the implications of this for the global economy?
Well, it's quite interesting, isn't it? Because you've got a whole host of factors hitting China. I think the biggest factor that we need to think about in China is that the population has peaked. That is the biggest thing that we need to bear in mind. There's a very good book was written back in 2020, I think, by Goodhart, the economist, and a colleague of his, which basically argued that the reason we've had, this comes back to wages as well, the reason we've had low inflation for 33 decades or so is because of the Chinese and the Eastern European workforce coming into the economy, and that's depressed everything for everybody. Now, if China employment has peaked and is going the other way, and it's now not cheap anymore, and let's say that it's the same for the Eastern Europe as well, that pressure has gone away. So that's one thing for China. But if your population is not growing, it's quite hard. Then there's no way they're going to do the 7, 6, 7, 8% growth rates they've done historically. That's not going to happen. So China is now in the process of having gone through industrialization. It's now moving towards becoming much more like a Western economy, and it needs to support itself with consumption, which is a huge task for it to move through. So will China be a huge driver of the world in terms of growth in the world like it has been in the past? We would argue not. So will they consume masses of commodities, iron ore? They will consume a lot because it's one of the largest economies in the world. And them opening up will obviously help that. So yes, we're positive on commodity stocks and industrial stocks going forward because opening up will help that. But the property market's not going to go back to the heights it was in China. You've still got companies bust left, right, and centre. Retail, I think house sales in China are down something like 20-something% year on year. House prices have fallen month on month in China for quite a number of months now. So there's a lot that needs to change there. And let's be honest, the reason why they're removing zero COVID is because they started to get civil unrest. And for the regime they've got there, that is the thing. That is the factor that they are the most scared of, because that's the thing that can basically kill their whole regime, basically, if they have civil unrest in the country and people on the streets, etc., and another revolution because of suppression. So that's why they're opening up, I think. But I think the other factor we need to layer on top of China is the nearshoring, reshoring, and the geopolitics of what's happening at the moment, in that it's clear that the US has decided that it's almost a kind of trade war going on with China, isn't it? It's a quasi-trade war. Yeah. You've seen what's happening in chips. Chips, you can't sell them to China. You know, ARM is the latest saying we can't sell our chips to China, etc., etc.
Yeah, there was a comment this week by someone in the chip industry, I think out in Taiwan, that actually what we're seeing is the end of globalization, which seems a bit extreme. It doesn't seem to be overjust yet. You know, if China, as you say, you know, isn't this sort of source of cheap manufacturing that we've become used to, is there a potential shift? So maintaining the same approach to sort of outsourcing, but using other countries. I know Vietnam is often talked about as a major beneficiary.
Yeah, if you've ever been to Vietnam, I've been to Vietnam. It's an amazing country. I mean, just the kind of it's a so-called communist country, but it's not. The kind of entrepreneurial nature of the people there is unbelievable. Yes, definitely. Places like Indonesia, Vietnam, they will benefit. But I think what companies are doing, and certainly companies we're talking to, this nearshoring. So what they're doing is they're looking at saying, and this is partly due to pandemic as well, I'm willing not to have it in country, but I'd like to have it in the same geographic block, as it were. So let's give an example. If you're in North America, if you're in US, you're quite happy to have supply from Canada or from Mexico. You might have a bit from Europe, but you don't certainly want it from Asia, because if things break down, you're in trouble. And similarly, if you're in Europe, you're very happy to have European supply, and the same for Asia. And I think that's what's happening. Look at the huge chip plants that are being built in Europe and in the US, for example. This is all behind this nearshoring or nearshoring. Reshoring is obviously when you bring it all to your own country. That's the extreme level of it. But definitely, I think there is this, and that's good for capital investment, of course, and should be good for productivity going forward for countries, because you're putting down new kit that's much more productive than the old kit. So that's why we're positive on that kind of area of the market, notwithstanding a short, shallow recession. that there's going to be a hell of a lot of capital investment. And then you add on top of that, if you're going to electrify the world, which is what we're all going to be doing, you've got all the investment for that as well. So that drives a lot of capital investment, and that could be the saviour for countries like Germany as well, of course, and things like that. Because when that all comes through, there's a lot of investment to go in, and I think that's what we see as leading us out of this shallow recession. Is that kind of commodities investment driving the economy forward? And we shouldn't forget that inflation actually hides a lot of sins, to be honest. I mean, it's quite interesting when you look at companies' results at the moment. They say that they're up, I don't know, we're growing by 6-7% and whatever, and they're not giving volumes. A lot of companies, some are. It's a bit of a bugbear of mine. And they're not giving volumes. We all know why they're not giving volumes, because actually volumes are down. But inflation hides that, doesn't it? Because inflation is actually putting your numbers up. Next year will be the test on that, of course, because inflation falls back, and you get a shallow recession. Then you'll have no price rises there to kind of bail you out. But yeah, China, I think, seeing them as the driver of the global economy going forward is not right. But that doesn't mean that the global economy won't grow, because you've got all these other factors that will drive it forward. And you've got this big opportunity, haven't you, to basically reduce carbon emissions and electrify the world.
Yeah, I mean, it's a huge opportunity. And you talk about energy. Obviously, we need a lot more of it, or we need different sources of it. It would seem.
Different sources, yeah.
There is a lot of sort of investment that hasn't happened over the years for whatever reason. So, do you think this capital investment is going to come from both companies and governments? And in the West, how do governments pay for this potential infrastructure splurge that we need? Because we are in a lot of debt.
Well, we are, and also the infrastructure is pretty old in the West. I mean, US in particular. I mean, some of the US infrastructure, bridges and things like that. I mean, and stuff like that. So, generally, what happens? Generally, how it works is the government seeds it, and then private sector takes up the mantle, as it were. So, I think that's what they're trying to do. But you have got, you've got what you're seeing at the moment. Look at the likes of Shell and BP, who've seen as pariahs by some, but they're investing billions in this whole new infrastructure for the new energy markets. Whether it's wind, whether it's storage, which obviously storage is the big thing we need. That's the real kind of block to actually moving the energy economy forward. There's lots of money being invested in that, and they're getting the returns on it. I think the issue, you've hit the nail on the head with governments. I mean, governments have just paid for the pandemic, of course. So they've got this issue: can they pay for it? No, they're going to have to incentivize the private sector to pay for it. Really, I think, because governments can't do it. But the returns should be there on it. I think, really, particularly if we've now got these higher power prices to stay.
Yeah, absolutely. Which is exactly what's happening with Sizewell up the road to me here, which may or may get built at some point. Who knows? Much to everyone's annoyance in the local area. I mean, when we were sort of prepping for this, you put something in the agenda: adults back in charge in the UK. Now, I think last time we spoke, we were probably still in the midst of or coming out of the sort of political chaos we were seeing here. Yes, we're broke as a country, but do you think we've actually got the right leadership now to actually get the job done, get us out of the mess that we are in?
We've certainly got a better leadership than we had for those few weeks. Let's be honest. So I think that if Truss and Kwarteng got one thing right, they had a plan. But the trouble was, the plan was a little bit destructive. Let's be honest. But I think the key for the UK is we need to have a plan of where we're going to go. And that all ties in with what we've just been talking about the structure of the energy market in the UK. What industries do we want to promote in the UK? What are we going to be in the UK going forward how are we going to interact with the rest of the world? And that is really what the government's job is, in my view, is to come out with a plan as to where we're going, as to how the next 30 years, where do we think the economy is going to go? And let's be blunt, if the Conservative Party wanted to get elected, I believe if they were to do something like that, they might have a chance. But the trouble is, in the UK, we have this short electoral cycle, and people don't tend to think that. But that's what's all important, I think. For the UK, we're indebted, but let's be honest, everyone else is indebted at the moment because of the pandemic. we need to come out with a plan of where we're going to go and how we're going to get there. And that's what's crucial looking forward. And then and that provides some kind of stability for corporates, for companies, as to plan themselselves. If you have some kind of a stable regime of tax and incentives and whatever it might be, then you can plan going forward because you know you've got that underpinning. If you don't have any idea what's going to happen, then how do you get inward investment? Why is someone going to invest in the UK if they, you get a windfall tax today that then disappears again tomorrow? You need to have a stable regime and some idea of where you're going to go. And I think that's what's crucial now. So yeah, the adults are back in charge. Let's be honest. We had that period where, I don't know about you, but that budget speech finished. And I was just sitting in, and literally people were just sitting in their chairs. People were just silent. Everyone was just in shock.
A gate, I think.
It was just, and then of course all hell then broke loose. So yeah, that's what I mean by the adults back in charge.
Yeah,
they've got a very difficult job. I mean, let's be honest. They've got a very difficult job, but they need to step up now and come up with some plan.
Yeah, and there was something that was published last week, I think, some proposed reforms to the city, which contain lots of interesting, sort of not a lot of detail, but sort of directionally, some very interesting.
A lot of consultation, lots of consultation.
Absolutely, but I think some of that's around sort of really making sure the city is a hub of green finance, really making sure that the sort of fintech, crypto industry is well supported here. Do you think these are the kind of things that will make a difference as part of the longer term plan?
I think it's good to see that they're thinking about these things. It's good to see that they're looking at how to free up raising capital in London, so that making it easier to raise capital. Obviously, you need to make sure you've still got controls in place and not free it up too much, because we can see what happens when that happens. But I think it's an encouraging sign that they're looking to plan forward as part of some kind of plan. And we all know that the city and the services from that are a major part of the UK economy. So if you get that growing, that's obviously provides a lot more tax income, which can now then help in terms of seeding the investment into the economy, and you get into a virtuous circle, don't you? So it's important that they're doing that. A lot of it's consultation at this stage, but it looks like it's going to be relatively rapid consultation, so that should be good. And then getting that into law, and it will be important. But yeah, it's important. It's good that we're seeing something like that. It can't be bad. And then we now need to see what the next steps are going to be in terms of where they want to take the economy looking forward.
Indeed. Let's look forward into 2023. I'm glad you talked about infrastructure, because this is the kind of thing that I've been banging on about a lot. I think investment in infrastructure is to me going to be the big play of the next few years. Whether it kicks off in 2023, I don't know. Is anything else you're looking for? Hopefully a better 2023, but anything specific?
As I said, I think we're looking for as markets look through what we think will be a shallow recession, which we're probably already in, then commodities and investment, I think, and definitely infrastructure will be part of that. So definitely agree with you on that. That's all part of that. What tends to lead out of a downturn is quality growth. I mean, it's a bit of a kind of catch-all kind of term, isn't it? But it tends to be quality growth in terms of the companies, because people feel a lot safer buying those companies before you see the recovery than when you see the recovery, and then the other companies would follow on. I would still be very careful about indebted companies. We started to see the odd one or two of those now, where you look at them and you go, it's okay, it's only 1.5 times net debt to EBITDA, but then you get a downgrade to EBITDA, the cash hasn't come in as expected, and suddenly you're looking at 2.5 times net debt to EBITDA, and you're going, oh my God. And then the equity part of the EV just gets squeezed. So be very careful. Now I think because companies are typically well funded, there aren't a masses of indebted companies at the moment, which is quite interesting, because typically when you go into a recession you do have, but we haven't got that this time around. But just be careful on indebted companies. But yeah, I think that whole kind of infrastructure, commodities, capital investment, industrial sector, that's definitely positive on all those areas of the market. On top of that, other areas we're positive on would be healthcare, Obviously, aging population, go back to the baby boomers retiring. It's going to continue to be big investment there. People aren't going to forget quickly what happened in the pandemic. So there's going to continue to be investment there. Digitization is going to continue to be key. If we're right about the global workforce, well, certainly the workforce in the Western world, shrinking, then productivity investment, digitization is going to become even more crucial for businesses to make themselves more efficient, so they can operate more efficiently with the same amount of people. So all those areas are great areas in terms of, and actually, if you look at that, UK is reasonably represented in terms of the UK equity market in terms of all those areas. We haven't probably got enough technology companies on the market. We've got quite a lot in the small and mid cap area, the small cap area. But yeah, those are the areas we'd pick out really to look for.
Brilliant. Well, yeah, it's a nice positive note to end what's been a horrible year on. Let's hope 2023 is better.
23's got to be better, hasn't it?
I touch wood.
Okay,
wonderful talking to you, Jamie, as always.
And you. Thank you very much.
Thank you.
Have a great Christmas.
And you.